The UK services sector contracted in May for the first time since April last year. The Purchasing Managers Index came in at 49.3, below the 50 threshold that separates expansion from contraction, down from 52.7 in April. That single reading carries more weight than it might appear to on a normal month, because it arrived at precisely the moment the Bank of England's own policymakers are debating whether to raise interest rates again. The FTSE 100 closed Tuesday down 1.4% at 10,219, even as Paris and Frankfurt gained over 1% and 1.7% respectively. That gap between London and the continent is not noise. It is capital repricing the specific risk of a central bank tightening into a softening economy. The immediate cause sits in the energy market. Brent crude was quoted around $110 a barrel on Tuesday, up from $108 at Friday's close. UK gas prices have surged to a 3-year high, with the month-ahead contract near 148 pence per therm, almost double the level of a week earlier. The Strait of Hormuz remains closed following U.S. strikes on Qeshm Island and Iranian missile launches at Kuwait and Bahrain, and the International Energy Agency has described the disruption as unprecedented. Economists have estimated that a sustained 40% rise in gas prices alone could add 0.7 percentage points to UK inflation, with oil contributing an additional 0.2 points on top. The energy price cap resets in July. Chancellor Rachel Reeves announced a temporary VAT cut to 5% on summer attractions and a $350 million critical chemicals resilience fund, but has not yet committed to a broad household energy support package. That decision is still outstanding. The gilt market has already moved. The UK 10-year yield climbed to 5.08% from 4.96% late Friday, a 12 basis point shift in less than a session. Sterling held near 1.3450 midday Wednesday, down from 1.3475, while GBP/EUR traded around 1.1580. Money markets have sharply reduced the probability of near-term rate cuts, with the chance of a March cut falling below 30%, compared with roughly 80% the previous week. What looked like a straightforward easing cycle 3 weeks ago has been reframed in a matter of days. The B&M session told part of the same story from the equity side. Profits fell nearly 50% year-on-year to £227 million. The dividend was cut by 36%, and the stock rose 15%, because adjusted EBITDA of £459 million beat a consensus of £450 million. When a profit collapse and a dividend cut produce a 15% share price gain, it signals that expectations have been so thoroughly reset that even bad numbers can trigger a squeeze. That is not confidence, it is position clearing.
The central tension of this session is that the Bank of England is being pushed toward raising rates by the same energy shock that is simultaneously contracting the economy it governs. Services PMI at 49.3 means firms are pulling back output. Hiring has now declined for 20 consecutive months, the longest uninterrupted period of job losses since early 2010. Input cost inflation is running at the second highest level since December 2022, and firms are passing those costs on at the second fastest pace in 3 years. MPC member Megan Green noted this week that services firms with no direct energy exposure were still raising prices, which means inflation is spreading beyond the commodity shock and becoming embedded in the sector precisely as that sector shrinks. That combination, contracting output, rising prices, falling employment, is not a standard cyclical setup. In a normal tightening cycle, the central bank raises rates to cool demand that has run too hot. Here, demand is already cooling. The bank is not being asked to suppress an overheating economy. It is being asked to suppress inflation arriving through supply destruction, not demand excess. The policy instrument, the overnight rate, is identical in both cases, but the transmission path is not. MUFG now forecasts 2 rate hikes, shifted to July and November. Governor Bailey said this week that policymakers still have time to assess incoming data, but that a July move remains a realistic possibility. The City AM shadow MPC voted 7-2 to hold, citing rising unemployment and near stagnation, but acknowledged that if oil reaches $150 a barrel and gas rises to 250 pence per therm, inflation could peak at 8% next year and stay above 6% until mid-2027. Ruth Gregory at Capital Economics framed the threshold clearly. At current energy levels, inflation stays in the 3 to 4% range. In the severe scenario, rate hikes become unavoidable. The bank is not choosing between easing and tightening. It is choosing between 2 kinds of damage, and the energy market is making that choice on its behalf. Here is where participant timing becomes the key variable. Mortgage approvals rose to 65,900 in April, the highest since January 2025. Consumer and corporate borrowing came in stronger than expected. Households and businesses are not waiting to see what the bank does. They are borrowing now ahead of what they expect to be higher rates. That front-running behavior carries a self-reinforcing quality. Stronger borrowing in April gives the MPC evidence that demand has not yet broken, which in turn makes the case for a July hike marginally stronger, which is exactly the outcome borrowers were trying to get ahead of. The gilt market, already at 5.08% on the 10-year, is pricing the distribution of outcomes that lies between those two groups. The unstated premise behind the hold camp is that the energy shock is temporary, and the bank can look through it, as it did briefly during the Ukraine conflict. The unstated premise behind the hike camp is that the spread of inflation into non-energy services proves the shock is already second round. Both camps are reading the same PMI at 49.3. Both premises cannot be correct, and the June data will force a reckoning between them.
Two scenarios now run in parallel, and the data over the next 6 weeks will determine which one dominates. The first, oil stabilizes below $120. The Strait of Hormuz shows any sign of partial reopening, and the energy price cap reset in July proves manageable without triggering a second-round wage response. In that case, the bank holds in June as expected. The market currently assigns roughly 90% probability to a hold at the 18th June meeting, and the July decision becomes genuinely data-dependent. Cephas's PMI recovering back above 50 in the June reading would be the clearest single signal that tightening can be deferred. Sterling would likely recover ground against the euro from current levels, and the gilt 10-year yield would ease back from 5.08%. Capital that has rotated out of UK equities into continental markets would have a reason to return. The second scenario runs from a different starting point. Energy prices escalate further, the July energy cap reset lands hard on household bills, and services inflation remains elevated in the June PMI reading. Green joins chief economist Hugh Pill in voting for a 25 basis point hike at the June meeting, which is itself now a live possibility rather than a tail risk. MUFG forecasts GBP euro drifting to 1.13 by the first quarter of 2027. UK 10-year gilt yields above 5.1% would put the government's fiscal arithmetic under fresh pressure ahead of any further spending decisions. The Chancellor's absence of a broad energy support package before the July cap reset would then read as a deliberate signal about how the government is weighting inflation against growth, a choice that gilt market has already begun to price. B&M's 15% gain on a 47% profit fall is a reminder that in this environment, the market is not rewarding good news. It is rewarding outcomes that are less bad than feared. Howden's acquisition of DIY kitchens at 8.5 times EBITDA reflects a different calculation, a trade-facing business paying £390 million to access the consumer who cannot afford a tradesman. Both signals point toward the same conclusion. The UK economy is being repriced around constrained disposal income and energy-driven cost pressure. The verification benchmark is precise. Watch the June services PMI flash estimate against the May final of 49.3, and watch whether the Strait of Hormuz shipping lane shows any material change before the 18th June Bank of England decision. The gilt market at 5.08% has already decided the question is open. Whether the June PMI confirms that judgment or refutes it determines whether the front-running mortgage borrowers of April were right to move early, or merely first in line to pay a rate the bank ultimately does not raise. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.